Welcome to the Interop. Today, my guest is Jonathan Caras, founder at Levana. It's a fully collateralized perpetuals exchange on osmosis, injective, and say. In today's conversation, we will discuss today's launch of the Bitcoin ETF and the market reaction to that news. We'll also discuss Levana's recent token launch and lessons learned. We'll talk about the recent attack on Levana, which drained about 10% of TVL. We'll get into what they learned from that attack and how it has been mitigated and how they've recovered. I'm also dying to find out why he thinks ETH won't be the best performer of smart contract platforms in this cycle. And today I'm joined by a special guest co-host, Farmer, who's my go-to DeFi guy in Cosmos. He's a trader and CEO of DeFi Dojo Validator.
Hey Seb, stoked to be here.
Great to have you. Before we get started, make sure to subscribe to get notified when new episodes drop every week. Remember that none of what we discuss here on the Interop is investment advice. And if you enjoy this content, please consider staking with us. We're validating on Evmos, Quicksilver, Osmosis, and Juno. And you know what? Why not also give some validator love to DeFi Dojo Validator? Just look for us in the active set. My guest, Jonathan Caras, is coming up next, right here on the Interop. We're here with Jonathan Caras from Levana. Hey, Jonathan, how's it going?
Hey, how's it going? Thanks. Madcap Slap. I lead communications at Levana, and Levana is a well-funded perpetual swap currently on Cosmos, deployed on Osmosis, Say, and Injective.
Yeah, and I mean, our listeners will know you from your previous appearance here on the podcast, which was back in September. Since then, it's been about 4 months have passed. Lots has happened. The token launched in early December, and recently there was an attack and a relaunch of Levana, which we'll get into detail during this conversation. But first, I think we should spend a couple of minutes here talking about the ETF approval. This just happened today.
Can you believe it? It has been. I feel like. I don't know what class you are. I'm like class of 2016. And we've been talking about this. You know, the institutions are coming for like 7 years now?
Absolutely. I mean, I'm class of 2014, and institutions were coming then too, right? I mean, the Winklevoss twins, I think, had submitted one of their earlier ETF applications, probably in 2014, but like at least we're working on it back then, if I remember correctly. And it does feel like institutions have been coming for a long time. And this is finally a moment where like the institutions are not only coming, but they're invited to come and they have direct access. And so I think it's going to be a massive moment. I mean, markets obviously have reacted very positively to this, but I think we're in for a crazy 2024. I think it's going to be such a massive year for crypto.
One of the things that I think is really interesting in terms of the ETF is that people often compare it to the gold ETF and how gold really only became an institutional product once, an ETF existed and you could just buy it, alongside, your broker. You could pick up a phone. I mean, I remember being a kid and my father would pick up the phone and, he'd be watching the news or something and he'd call his broker and tell him to, place a stock order. And that was really the turning point for gold. And so there's definitely a lot of comparisons to, Bitcoin having its shining moment, with the narrative of the upcoming halving and everything else, to gold really becoming an institutional grade product with a similar listing. And one of the things that I think is so interesting is if you compare how the gold industry was impacted by the creation of the ETF. It was not just a retail moment, but it was an industrial moment for gold. That now there was literally a gold rush to be able to to own more mining, to optimize mining. And I don't have the numbers offhand, but I saw some reports earlier today that gold production went up, significant multiples in the years following the ETF. And if you compare this to Bitcoin, it's like night and day, that it doesn't matter how many institutions mine Bitcoin, there's always going to be the same block reward for finding the nonce.
Hmm.
And we're about to go through the macro Bitcoin cycle in May with the halving. And so there's going to be a whole new class of investors that Bitcoin was not within their appetite when it was on Coinbase, or it was something that wasn't being peddled by the same suits that were peddling all the other commodities that they were sweeping up. And then now anyone that went through the major cycle with gold, and understands the correlation between the ETF and the increase in supply, will be forced to learn about the halving narrative, and then the inverse relationship of the potential increase in demand, or at least increase of availability, with the mirrored aspect of the massive decrease in stock. So I think we're in for a wild ride that is, at least in my personal, not financial advice opinion, has not it's not even possible to be priced in, because the educational process of the real money hasn't even begun yet.
Yeah, I totally agree with that. I think the most bullish thing coming out of this is all the marketing that is being done right now, pushed out, all the commercials we're seeing that are coming out from like the most trusted institutions in the world, the institutions that my parents and grandparents would have used over the last 100 years. Like Franklin Templeton changed their Twitter page photo to Ben Franklin with laser eyes.
Huge. Yeah.
I don't even know what any of that means. I haven't seen a television commercial in,
Yeah.
I don't know, years, but
I'm just seeing them on
yeah,
Twitter, but
yeah.
that's
Got
incredible.
it.
And there's just so many like bullish things happening this year. It's just like I think like the market has reacted like exactly how a lot of people thought. It's like a lot of smart money front ran the narrative, and then maybe we'll see a little bit of cool down in Q1, and then after the halving, just kind of up only. So it's super exciting time.
Absolutely.
Yeah, it
Well,
makes me think of all of the Bitcoin that sacrificed over the years, to BitMEX, to various, you know, uh, I don't know, send and receive. There were a lot of mistakes made along the ways, and but I'm very excited to see, Bitcoin is still the only asset that I let my kids buy. So it'll be interesting to see how this how it holds up in their paper wallets.
and now they can pick up the phone and call their broker and just, place that order, like pick up their rotary phone and call the broker.
Yeah, exactly. They'll, they'll,
I
they'll,
just
they'll
when
they'll
you were
just
said
send
your
the
dad
carrier
was
pigeon
was calling
out.
his broker, I could just like imagine like a guy in his 40s sitting on a couch with a rotary phone, like, hey Jimmy, like put in an order for
Exactly.
yeah. So, yeah, no, it's definitely exciting, and yeah, I also think that the Q1, we won't see the real market action probably until after the halving, and yeah, I think when we do this again next year, when we talk in a year from now, the market will be in a very different place, and in a large part that'll be thanks to this announcement, and all the institutional liquidity coming into the space, not only in Bitcoin but also in other assets as well. Hopefully,
Yeah,
um,
it does seem that most people think that the ETH ETF narrative will start now, and that's the new hype cycle and the new narrative to push altcoins forward over the next few months.
I mean, there's always kind of I mean, what would this be? This is probably my fourth cycle now. So, I mean, there's always money flows into Bitcoin, and then they learn about smart contracts, and then it flows into ETH, and then it flows into alt, and then it flows into NFTs, and then, and somewhere meme coins kind of picks up at everything that like kind of, falls to the wayside, pouring from one bucket into the next. But I'm actually, I don't know. Is this a contrarian view? I'm not sure, but I'm not particularly bullish on ETH being the best performer of the smart contract platforms.
Hmm.
Just because I believe that it's very hard for ETH to gain new users within retail, just because of I mean the scalability and the price point. So if I had to put money, and I guess I do, into different smart contracts, I would be much more bullish on the Cosmos ecosystem, which has its challenges because Cosmos doesn't necessarily have a central token to represent it. I mean, there's Atom, but Atom is a different beast than when you compare it to like AVAX or Solana or some of these other much more homogenistic tokens which represent the ecosystems.
Yeah, that's interesting. Even with AVAX, as they got really congested and busy over the last few weeks, and it's supposed to be like the gaming chain, they transaction fees were up around $200 or $300 for one transaction on AVAX. So it
I
sort
did
of
see that. Yeah,
gets into
that was
that
from
same like
inscriptions,
ETH sort
right?
of area where like it's not going to be interesting as a gaming chain for like someone to get on and buy a $10 skin and then pay a $300 transaction fee. So I think you're spot on that a lot of retail is going to flow into like Solana and the Cosmos ecosystem. We've already seen that at the beginning of this bull run.
You can't continue your narrative if you have massive transaction fees. I think that gaming, probably the ZK play amongst Polygon and Immutable is my favorite horse in the race, or horses in the race from the gaming perspective, just because ZK Tech, which and I came from that world, and I did BD at Starkware for a while. And I think that it is the most versatile technology to bridge, centralized systems to trustless systems. So it's, but that I get, I think that it's anybody's game at this point to capture value there.
So yeah, let's move on to Levana, and specifically, I think we wanted to talk about the last 5 to 6 weeks. And before we get into the attack and the subsequent relaunch of Levana, I want to get a little bit of retrospective on the token launch, which was in early December. Now there were some issues around the token launch, and wanted to ask you like what you learned from that experience, and sort of what are some of the points of advice that you give to other projects that are launching tokens this year?
Oh, for sure. I think just in recent memory of token launches that I can recall, it was probably the messiest token launch that has happened, in that I in a while. A lot of learning experiences from it. There's always going to be drama and mistakes, or looking back saying like, oh, this, how could that have happened, or what? I think that if I would, I've started to put together some thoughts of advice for other projects that want to launch tokens, but within the Cosmos ecosystem and within the, but just in general in 2024. I think that the timing of events is really critical. You really have to model the flow of the launch and the volatility around the launch. And I think it's probably safest to, if you do have centralized exchanges involved first, if there's like rewards or airdrops as part of the launch on centralized exchanges, it's probably best to get that out of the way before you start integrating anything on chain, because there's going to be a massive amount of volatility associated with that. Most projects launch with some type of an airdrop, so it's good to time the airdrop with with the DEX listings, and not to separate them, which could be, from an operational perspective, could have a lot of merits to it, because teams. I think that there were people on the Levana team that didn't sleep for like almost a week. Or slept maybe 2 hours a day for almost a week, myself included, around the time of launch. And then you also have to consider that the launch, because it's such a heavy focus. So then it also puts you from a security perspective at a high level of risk because it brings a lot of attention to the project, both for the good and the bad. And what it does is it it notifies potential bad actors that the team is under fatigue, is primarily concentrating on the on the protocol itself, or on the launch itself, and then that can allow for nefarious actions to occur that very easily could have been caught under different circumstances. So I think we saw kind of a comedy of errors where one mistake then created more stress and challenges, which then made it easier for multiple mistakes to occur. And we could, yeah, definitely break that down. And I think there's a whole master class to go over, and help the next generation to succeed here. But it's it's probably outside of the scope of this call, and I'd probably have to put things down on paper first, more eloquently, in order to accurately go through all of the learnings from it.
Looking back on it now, do you wish that you had maybe done something more like fully decentralized and left the centralized exchanges out of it totally, something like StreamSwap? So I know that I've been using, I used StreamSwap for two or three of the streams this year, and it was like by far my favorite way to launch. So the market conditions were horrible, so like the launches weren't as good as the founders hoped that they would be, but it was a way that I could securely get as many tokens as I wanted, or as many as I was comfortable with, as long as I was staying in the stream without affecting the token price that would happen if the tokens just launched on Osmosis or a centralized exchange when there's
So
low
I think
liquidity. So.
so there's a couple different facets to this question. So one is StreamSwap itself. StreamSwap is a challenging product to use from a compliance perspective. We spoke with the builders of StreamSwap. We spoke with compliance overseers from a number of different areas that were very conservative about the use of StreamSwap. And we brought this up with the StreamSwap team. It was actually our first plan was to use StreamSwap, and we worked out I think a very nice strategy that leveraged that technology, because I do think that it's I would say that my favorite is probably Delphi's liquidity bootstrapping auction. Which is very similar to StreamSwap, but instead of actually receiving the token, you actually receive an LP token for in Delphi's case it was for Astroport. So imagine a stream swap where you might put in a stable coin, and then what you get back is a pro rata share of an LP token, which has some type of vesting associated with it. So that was the ideal launch mechanism, in my opinion, which is very similar in structure and price discovery as StreamSwap. But StreamSwap is, you directly, are, you arguably it's much more of an ICO flavor, um, which is dependent upon who you ask. Has you'll get different answers to the usability of that, and so very excited to see StreamSwap grow and mature, and hopefully adopt some of the methodology like what Delphi had created back in the days of Terra, and I think more recently Vertex, which is also an Xterra project utilized, if I'm not mistaken. But yeah, definitely, I'm a huge fan of what StreamSwap has built, and I agree with you. I've participated in some of in one of the previous StreamSwaps, and it was a wonderful experience. Now, putting to the side the the problem with trying at this stage to cut out the world of centralized exchanges is it really cuts you out from the onboarding and from the discovery. Meaning, Levana's been live for 6 months on Osmosis and is the by far the most successful third-party app that's been deployed on Osmosis. Like, there's been $1.6 billion worth of trading volume. There's been 16,000 unique wallets that have interacted with it. There's been, I think, $1.8 million paid out to users on Osmosis. To clarify, not to Osmosis stakers, but actual users of Osmosis. Um, and a ballpark of that. I don't remember what the exact numbers are. So, in terms of awareness and growth, if Levana, one of Levana's goals is to 10x the active user base on Osmosis, and that is one of our active goals, then that can't happen by only being exposed within the walled garden that is Osmosis and is the Cosmos ecosystem. So while we were very, proud to be to mint the token on Osmosis and to be a trailblazer there, we were also very proud to teach a number of exchanges how to interact with native tokens on Osmosis, and what does it mean to be a Cosmos, an active Cosmos participant, from a DApp perspective, not from an app chain perspective. And personally, I don't believe in the app chain thesis. I think that it goes counter to many of the fundamentals of successful startup methodology. That doesn't make sense to be both a startup and to run your own infrastructure, or to pay the overhead of your own security when you could just rent it. And so it's I think that what part of what Levana's goal is to be a trailblazer, to try things that haven't been tried before, to have kind of zero fear of failure. You can't, it's very hard to do innovative things if you are afraid of failing. And Levana's failed many times before, and every time that we failed, we've just gotten up, dusted ourselves off, spit out the blood, and just kept on going forward. So that's our general methodology with whatever, however the project pushes forward. So I think that while it, if I was to go back, as I said before, probably would have, over the course of like a 72-hour period, first had the centralized exchange launch, then followed by the airdrop, then followed by the dexes. And that wasn't the order that things went in. And I think that hindsight is 2020. But I think that ultimately, if you just look at the the core metrics of the goal of a token launch, which is distribution of token holders, a comparative, you know, a relative value, amongst peers, um, and being able to create a path where the utility of the token is actually can be utilized within the user base that cares to be an active participant. I think that the token launch was a success. So it had a lot of mistakes, but if you look once the dust settled, the token is currently being held by the people that are most important to be holders, and the distribution is broad, and the utility, which is being mapped now primarily through open building. Which is another principle that Levana goes through, is that we build a lot in the open. So we do a lot of usability research. We do a lot of user feedback. We publish drafts of documents. We open it for comments from the community. So this feedback that we're getting through this form of open development by people that actually are currently holding the token has been a really valuable experience from our perspective, and we're excited to really continue building with the community.
These are great insights. I think anybody who's launching a protocol and launching a token should definitely, take note here on, some of the lessons
And
that
I'd be
you're
happy to
sharing
hop on
here.
a call if there is anybody that, is building or thinking of deploying or thinking of minting on Osmosis, or, deciding between app chain or DApp. I'd be more than happy to hop on a call and to kind of give you the whole rundown of the good and the bad and the ugly.
Well, we'll put your Twitter in the show notes so people know where to find you. Let's move on to the attack that happened. I guess just after Christmas. It was like
Well, it
December.
was in phases.
It
There
was
was
in
a lot of,
phases,
that's
but it
what,
started
yeah.
kind of. It became public, or you guys started publicly announcing that the chain was under attack, I believe on the 26th of December. But yeah,
Yeah.
walk
So
us
it's
through
it
the timeline
started.
here. Yeah.
Yeah, so it started 13 days earlier. It really started with a ransomware attack on Levana, where we started seeing, DDoS attacks. And then on the 17th, we were approached by multiple individuals that said that they were responsible for, shutting down indexers, shutting down the front end, shutting down bots, and they wanted essentially to, it was a ransom, so they wanted to get paid to stop attacking. And so that, we were in the process of attempting to resolve those issues while at the same time attempting to plan the to push through with the token launch. And there was a little bit of COVID on the team involved in there, so that didn't make things easier. But then by the the morning of the 26th, it was very clear that what was, happening, which we before the 13th, LP pools were traders were losing more than they won. So from the beginning of the launch of the protocol, which I believe was on July 16th, up until December 13th, the average traders, I think, had a 48% success rate, meaning that they lost slightly more than they won. And so that delta, was an extra APR lining the LPs. And then on the 13th, it shifted, and the success rate, average success rate of the traders just started going up, 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 up until it was like, until it like hockey sticked. And then that was, and looking back on it in hindsight, that there should have been, I think that if, well, again, hindsight is always 2020, but there were definitely ways that we could have been better prepared, moving up, just having the forethought that, as we move into the token launch, the team is going to be spread thin, and that's going to expose us to attacks. And then kind of coupling, that, if there's DDoS attacks, maybe those are distractions, maybe those are part of, something more nefarious. But ultimately, what it led to was on the 26th, there was a massive attack where, over $500,000 was drained from the LP pools on Levana. Not all LP pools, just specific ones. And prior to that, over another 12-day period, a similar amount. So they had slowly bled for about 12 days, trying to just keep us distracted, as we went into the token launch, kind of like on, wild goose chases with, the various ransom attacks. And then they went in for the kill on the 26th. And from what we can understand, their goal really was to drain the entire LP. And because of numerous mitigations, safety measures that were in place, they were only able to drain about 4% on that day. So about 12%, about 12 days it took them to drain 5%. And then in about, I'd say, a few hours, they were able to drain another 4%. So it was roughly about 10% in total.
Okay.
Yeah.
Wow. So this happened over about a 2 week period. Meanwhile, they were keeping your attention occupied somewhere else by DDoSing some of the back end infrastructure, while at the same time like draining the pools.
Well, and it actually ended up being that the DDoS attack was what enabled the on-chain attack as well. So I can walk through that, I can walk through that in detail.
Which pools were targeted, and is there like anything interesting to learn from that? Like any specific types of collateral or anything like that? So, specifically like a liquid stake token as collateral might be more volatile than a large cap token. So I was just wondering if like that had anything to do with it, or if it was just the attack.
So I mean the largest ones, when they went to the first ones that they started with over, the 12-day period were the smaller cap synthetic markets. And I think that those were just less frequently used. Some of them, had, less than 50K TVL in them. So it was just, I think those were just kind of, that was the learning experience from the attacker. And then, the majority of the losses were, if I recall correctly, were to the Bitcoin, ETH, Atom, and ST Atom pools. But we've got, we haven't, there's still more work to be done to go through all of the transactions. I mean, it's a non-trivial task to go through all the non-trivial transactions over those 13 days and to analyze, each of the open, close, and update orders and say, was this a legitimate actor like trader? Or was this likely to be a malicious actor? So there are, there are 7 wallets that profited significantly, and about 9 wallets in total that seem to be involved in the attack. But it's still important to be able to, if you're looking at this in terms of the impact on the protocol, it's important to overlay that with that the time period that the attack happened of these 13 days was also a time at the very beginning of the bull run, which when you have a system with counterparty vaults, that's just like how bear markets make counterparty vaults, very wealthy. We saw even like some of the counterparty vaults, earned like 12% interest like a month. So that's in addition to the fees that they were being paid. So that was like triple digit APRs. So also they can get haircuts, during times where there's, quick bull runs because it is a zero sum, game that, trader wins have to be somebody else's losses. The system is designed to not, to prevent insolvency. So so I think that, they went after some of the easier targets, the less popular markets when they were in the experimental phase, and then when they actually went in for the kill to just try and to get everything, they went for the largest liquidity pools.
So in terms of so about 10% of the pools were affected.
10% of the TVL.
Sorry, 10% of the TVL was affected. How many
Yep.
transactions are we talking about here? Have you been able to account for all? I mean, for most of the transactions, I suppose, but how many transactions are we talking about?
It was, I don't know the order of magnitude, so I'm just going to throw a dart out there and say, you know, tens of thousands to low hundreds of thousands of transactions.
Wow. Okay,
But
that's
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 impressive.
purely conjecture.
Yeah.
I'm sure there's somebody else on the team that's more hands-on. And most of the we've kind of split up the recovery into a few different phases. So one is get back is fix the problem and get outside feedback about the mitigation to the problem, and then to get the markets back up online, and then to continue with the progress, which was our existing roadmap, which was to define the token economics, build out the LVN token staking, build out governance, and then launch the utility of the protocol. And then once we've launched the utility of the protocol, so then we'll be able to do an airdrop to the LPs that were affected. And it's the details of that are still vague at this point in terms of timeline and exactly what will be the terms and eligibility. But the goal is to to soften the sting, as much as possible.
Hmm.
And that, a lot of that is just we're looking at a timeline of around Q2 of this year. We think we'll be ready to complete a process of review, of analysis of separating legitimate transactions from malicious transactions, and then also being able to do an airdrop focus on the LPs of the during that time period.
Yeah. Well, we'll talk about the staking and token economics plan a little bit later. I'd like to dig into the how this attack works. So this is an attack that doesn't. I mean, the idea here isn't to find vulnerabilities in the smart contract. But what this attack does is it leverages oracles in order to uh, to benefit from a discrepancy in price. And there's other sort of mechanics to the attack, but I'd like you to describe just how this attack works and how it involves the external oracles that you use. I believe it's Pith.
Yep. And I first want to, say that, Pith did a great job. Pith worked exactly how it was designed to work. Pith is a great partner. And so I don't want to mislead or throw anybody else under the bus here. Um, the way that the attack works is that there's a concept of staleness of price updates. The blockchain doesn't know anything outside of itself. And a blockchain needs to have information pushed to it. A blockchain doesn't pull. And so what was, what happened, what happens with price substantiation, I think that's how you say it in English, um, is that Pith will sign a price at a price point off chain, and then anybody can take that price point with their signature and then essentially write it on chain into Pith's Oracle contract. And then now that block, which in Osmosis is a 6-second block, roughly, that block will now include this specific price point. Now, it could also be a historical price point with some type of staleness to it. And what we saw at Levana was that just through regular use under normal circumstances, a price point a normal user could take about a minute and a half to to get out their ledger, to approve it, to connect their wallet, to unlock their wallet, and to put an order on chain. Now, there are bots which are community run and also run by the Levana core contributors, which update the prices on chain on Osmosis far more frequently, or with a goal of far more frequently. And so what was a big part of the attack, and I'll describe how the attack works. Imagine that there's a point of high volatility, and I can write an order. I see that 30 seconds ago, 60 seconds ago, sometime within the staleness window, there was a 1% price move. Okay. And it's not going to happen all the time, but it happens. Crypto will run. So I see that previous price point, and I see the current price point, and I see that there's a delta. So now, if I can issue within 2 simultaneous blocks this old price point, which is within the staleness time frame, meaning it's not going to be rejected because it's too stale. So if I can print this to the chain along with my order, which then gets opened at this price, and the direction that I know, because I know that the current price is up here, then within kind of that 12-second window, I can both open a position at a low price, and then next block close a position at a higher price, and I will deterministically know whether or not that delta of those 2 price points, which I both created on chain, will result in more profit than the fees that I had to pay in order to perform those actions. Now, if the profit deterministically is greater than the fees, then that becomes a risk-free trade. And now, what also needs to happen is that, because I'm not using the price point here, I'm actually using a price point over here. Let's say that this was like a 30-second or 60-second time window. I just need to make sure that nobody else, no other users of Levana, nobody else on the Osmosis blockchain, that Pith, that nobody else is interfering or intercepting my 2 price points by publishing like let's say that there were 10 blocks, but from when this price point should have gone on chain, um, to when I actually place the order. So now I need to make sure that nobody else during those 10 blocks publishes an updated price, because then I'll lose that low historical
And
price.
you achieve
So
that just by kind of front running any other attempts by offering a higher transaction fee. Is this how that works?
no, so that's so there isn't so it's um I'm not sure if it's Tendermint or it's yeah, I'm not sure where to from the architectural point um, to answer this question, but it's a FIFO system. It's not it's not
Right.
it's not a
Yeah.
market-based system.
Right.
So
That's correct. So
um,
Tendermint is a FIFO system as opposed to say like Ethereum, where if you pay more, transaction fees,
then you can front run.
then
So
you
the
can front
front
run. Yeah.
running has other methods, but and front running is also can be very expensive um, And so what happened also, so no, it's just really what you have to do is knock the bots offline, and then disrupt. Like
You just got to
let's
be
say that
first. You just
you,
got whatever it takes you to be first. So you
but not
DDoS all the
first. You have to be
bots.
first and only. You
Yeah.
know,
Okay. First and only. Yeah.
Yep. So I need to be first and I need to be only. So now one of the other things is that after the Celestia launch, um, Osmosis did something really awesome, which I think shows, and they did, then and Skip I think plays a role in this, is that they introduced a scaling fee structure that when congestion increases, fees increase as well. So this adjust for like the FIFO system um, that you have to pay more during times of congestions, which is great. That's how toll booths should work. That's how the free market works. Water costs more in the desert, than it does on a tropical island. Um, and so what you end up with is what we found on the 26th was um, that many native user transactions were unable to go through because of idiosyncrasies amongst various nodes in terms of gas price estimate.
Yeah, I was just wondering if like you've heard or are interested or excited about any of the other like Oracle solutions that are Cosmos based, and if that would be better and prevent this or not. So I know, like you mentioned, Skip, they have talked about building a proprietary Oracle on Osmosis, and I know like Umi already has an Oracle Oho, although I'm not sure it has the amount of information that you would want to be. Is the issue with oracles that like Pith has so much more information so that you can scale more quickly to like newer chains to have more information? Or do you think it's a better product in general?
I think Pith is a great product. I also think that Umi's Oho Oracle is also a great product, and we're excited to integrate that as well. We announced, I think, about 2 months ago, that we're interested in working with them. There's two methodologies. Oracles can be written, Oracle price, updates can be written to the chain either as part of block production, just natively built in to the blockchain. That's what Terra had. Say has that. A few other chains in Cosmos have that, or it can be pushed in, by third-party actors. In the case of Oho and Pith, it's through third-party actors like Levana, Levana users, Levana bots, Levana bot operators, etc. Now, the difference there is that blocks can miss price updates, and then you can get these types of, precognition attacks. And and I don't think that a different Oracle with the same implementation as the push to chain through non-block producers solves this particular problem. There are ways, we're currently live with Pith, with the mitigation in place, and I can talk a little bit more about how the mitigation works. But so there's ways to solve this with Pith. But the Skip's approach, which is let's just put Oracle price feeds at the head of every block, and we'll have a decentralized group of validators that are agreeing on prices. I think that's a great solution, but it's always going to be more limited in its versatility. That means that if you want to get, it's much easier for Pith to just say, "Oh, guys, there's um, a new market. Let's just throw that in." And now anybody can pull that price feed in, and they have literally hundreds of prices. It's not realistic, at least as far as I understand, to expect to fit at the head of every block, you know, potentially thousands of price assets. And Levana is an acronym for leverage any asset. And so the challenge there is that how do we build something where we want to leverage any asset where the on-chain canonical Oracle might only have 5 assets or 10 assets. Now, I think that it need not be either or. Those 10 assets that Skip will be producing onto Osmosis are a huge benefit because they'll be the 10 most popular assets, or they'll be
Yeah.
the 50 most popular assets, or the 100 most popular assets. So regardless, that's a great solution.
I mean,
But it
wouldn't
doesn't really.
osmosis just be? Wouldn't it be beneficial for osmosis just to include the price of all of the assets that it is itself that you can trade on osmosis? I mean, that would just like at least cover all of the, I mean, all of the Cosmos chains
Sure,
and
but Levana
possibly
has
also
Doge markets and Solana markets,
right.
and we've got the Great British Pound and Euro and all these other markets. So yes, it makes sense for Osmosis to include those, all the assets that trade, or at least that trade popularly, on the Osmosis DEX. But I think that that's going to be a subset of the assets that users want to have, to be able to trade within leverage markets and to be able to short and hedge and things like that.
Right, right. No, that makes sense. Uh, what do we learn from this attack? I mean, what are the
So
main
what
takeaways here for Levana, but I mean also just for DeFi protocols that leverage oracles?
I think that you have to decouple Oracle updates from position updates. That's the mitigation that we took, and we didn't even need to invent it. Synthetics had been through this road with a very similar hack a few years ago. So you know Farmer, I'm curious if you have any thoughts about the Oracle thing before I jump into the mitigation.
No, that was interesting. That clarified a lot of questions for me. And it makes a lot of sense. Like Osmosis isn't going to run an oracle that, does the price of corn and wheat, which or oil, and that ends up being something really interesting to 50 and 100x leverage traders. So if you're
Or
going to
even
leverage
just like
trading
some
points,
random meme coin on like, you
right?
know, it could be like some weird blockchain does a meme coin, it goes crazy, and people want to have instant leverage, access to it.
Well, and the irony of like using the decentralized system is that it becomes less decentralized from you because then users can't list any asset that they want because that's the end game, right? Is that like a protocol or a user could create permissionlessly their own Levana pool, seed it with their own money, and then people could start trading that asset leverage without any permissions from Levana or Osmosis.
That's the goal. Ultimately, what we want is to be the Uniswap of leverage trading, and it's
Hmm.
probably I would estimate we're probably about 3 years away from that. So, but that's the goal that we want to get to. There's a lot of work that needs to be done. There's a lot of governance that needs to be done. The I mean, there's a lot of work. There's a lot of like PIDs that like automatic. There's a lot of customization for each market in terms of the artificial slippage, the fee structure, the max amount of delta neutrality that a market is able to take on in one direction. So a lot of those things are done by Levana architects and third party architects. that we work with. And so we'd want to create, one of our goals is to create a methodology where, you could really plug in a CoinGecko chart, and then it will just analyze and then, wrap, and configure all of these things without the need for like the white glove treatment, what we have today.
So since this has happened, I mean, the protocol was markets were offline for some time over New Year's, but they're starting to come back online again. Can you talk about the mitigation and then the relaunch, which I believe all markets are back up now, correct?
Yep. All markets are back up. I think it's 27 markets, might be 26 markets. I have to count again. So all markets are back up. We've been fully live for 24 hours. Um, we People missed us, I had numerous people that just said like that wrote to us and were like, "Oh, we're so happy to see you. So glad that, there was a lot of positivity." So it was very nice to see that. Currently clocking $20.4 million of trading volume in the last 24 hours. So
How
that's
much was that before all this? Like, what was your average trading day?
Average day, depend on the day of the week and the volatility of the market. It could have been anywhere from low days were $5 million to high days were, $50 million. But and then obviously when the attacker came in, they just, when you can pick every trade as a win, so their trading volume like shot up.
Mm.
Um, but I would say, spitballing kind of like 15 to 20 was our average. So I think that that shows that the core user base of Levana, has been patiently waiting, since, I mean, we were, what is December 26th until today? Um, what is that? That's five plus 11. So 16 days, the protocol wouldn't allow for any new open orders. The protocol was running uninterrupted the entire time. It's just until there was um, until there was a fix to the Oracle, the precognition attack, no new open orders were available.
What happened to existing orders that were open throughout the entire process?
I mean, they didn't pose any risk, because once an order is open for, a few minutes, the whole concept of precognition doesn't mean anything. Um, and so some of those orders, closed. I mean, users could just interact with the protocol like normal. They could close them. They could, we didn't allow for updates because updates was also, there's plenty of ways to kind of, finagle it that updates is, essentially making a new order. So they had the option of just keeping it open or closing it. And so many people, kept their orders open throughout the entire time period if the market moved in their favor. But many people closed at the time that they felt right, and trigger orders, stop losses and take profits were also functional, at least as far as I'm aware, during this time period. So many people just were. If the market ran and you had a stop loss, that stop loss, saved your butt. And in the same way, if you take profits, the take profits made you a Chad.
So about 10% was taken from the pools, and I thought it was a lot more than that originally. So I think that's great that it was like stopped and found within that amount of time. So I
Well,
think that's
actually, the
amazing.
system protected itself. It wasn't, because there's a few safety measures that just kind of go into Levana. There's a max amount of open interest, disbalance, imbalance, that you can have,
Mhm.
and you also can't interact with other trader wins. So we silo each trade position. So the attacker was actually competing with other traders. If and that's also why they became so aggressive at trying to block anyone else from using the protocol, because they wanted to make sure that they got as much of the open interest as possible. But yeah, I think, look, thank God this, some many protocols, with far more TVL than 10, 10, 12 million bucks have suffered far more cataclysmic, um, awful, um, exploits. And I think that that was just a testament to a lot of the safety features that were just built into the protocol itself. And, I wouldn't say the fast response, because 12, 13 days is not a fast response time, but once it became very clear that that all of these pieces kind of tied together, on-chain congestion, off-chain DDoSing, and the precognition attack, once these kind of the once it became clear that these things were all related, then various operators were able to put on emergency modes, which was also great insight that these emergency modes were just part of the smart contracts, even with the subtlety of just stop open orders. Just as long as you stop like new open orders, you don't have to eject everything. You don't have to, mess with anybody that, like previously had a position and was in profit, etc. Just prevent new open orders from occurring. So that was, that was the I think a big part that prevented, a really, really nasty event from occurring. Not to say that it wasn't nasty. To go into the mitigation. Now there's complete decoupling of price updates and order updates. So creating an order, updating an order, closing an order, they come on chain without any interaction with a specific price. They go into a queue and then they're popped FIFO through a queue, and then paired with a future price update. And the price update has to both be not stale and be later than the position that was created on chain. And this has some fundamental principles to it, that even if an attacker controlled the entire chain, they still would not be able to deterministically create profit. And now, obviously, there's things that they could do to, mess with the odds in their favor, but then it would be just a probabilistic attack, which is far different because you have, it's always with blockchain, it's always challenging, because at the end of the day, if you say, oh, I can control every aspect of the chain, so then you do have a lot of control. But to ensure that there's nothing deterministic that allows for them to be able to win is a big is a huge improvement to the security of the protocol. And we were very, I was very excited to see the team and, in less than 3 weeks be able to get that out, get it independently reviewed, and, get it to tested and then into the market.
That's awesome. Well, while we have a few more minutes, I'd love to hear your thoughts on, and of course, like none of this stuff is going to be nailed down, and you're not promising anyone anything, but um, an obvious way to incentivize TVL and Levana would be to add LVN tokens to the already existing APR, and then the higher the TVL, then the higher the trade volume, and whales could come in. Another
Exactly.
interesting thing I'd like to ask about is like DAO or some sort of staking mechanism that you all are thinking about. Different ways for governance, but as well as I'm sure people are interested in how they can earn protocol liquidity through staking.
Yep. So currently you can earn LVN tokens via staking to two pools on Osmosis, the Osmo LVN pool or the LVN USDC pool. We do have pools on Astroport on Say and Injective, and those will be incentivized in the future. And then in addition, we've been talking with both the DAO and the enterprise teams to get staking and governance voting. Um, and ultimately, the protocol is, as many perps are, is incredibly profitable. Um, and we're very excited, to have functional, active governance, in the future, which our target is to roll out sometime by end of Q1, mid Q2, and where the the protocol revenue is governed by the stakers, who are then earning APR, which can be both, inflationary APR, through token emissions, and then non-inflationary APR through the actual, fees that are collected by the protocol. And that's, ultimately the details of that are going to be worked out through governance. But I think that the structure that we have, looking at the osmosis taker fees, looking at Kajira APR, looking at Mars's fees going to Mars stakers, Astroport, using their fees to buy back Astro token and then distribute that to staking rewards. There's there's a lot of different subtle ways to um, align incentives, and Levana is very excited to climb on the shoulders of giants of these great protocols that have come before us, but to also be a trailblazer at the same time.
Well, it sounds like despite everything that's happened, there's a positive outlook for Levana, which is great to hear. I mean, a lot of times when these things happen, we've seen a lot of protocols go through attacks or go through some hardships and never really recover from those. I don't feel like this is the case here. Trading volume is up. The community, I think, is supportive, and so that leads me, I guess, to the question of trust. Like, it's sometimes hard to gain the trust of users, and especially when something like this happens, to recapture that trust. Why do you think that users and traders sort of have kept their trust in Levana, and are eager to come back to the platform? Because, like, there are risks here, right? And certainly, yeah.
Absolutely. I think it's first of all, perpetuals and leverage trading um, is a risk on environment. And so I think to some extent you have to have platform risk as part of your calculation. When you go 30 long on some altcoin, like the risk tolerance has to be relatively high. And I think that Levana has done a good job of just being open and communicative. And there were updates multiple times a day, every day on Discord. Answered lots of direct messages. Um, and I think we're also just resilient. We've been building Levana for 3 years now. Raised over $15 million. We've got now multiple years of runway. The team is like seasoned. We cut our teeth on the Terra crash, and we tried to launch on Juno, and that kind of did its own thing. And so I think it's just it's Levana is a very, like any dragon, is a very hard beast to kill. And so I look forward to, the year of the dragon, which is starting in a couple months.
That's right. Yeah.
And yeah, we've just got, we've whatever the world throws at us, we're just going to keep on building.
Well, I think that's a great note to end on. Thanks so much for coming on again and walking us through the attack and sharing lots of great insights as well. I think there's a lot of good nuggets in here. I think this will be a good
Thank you
episode
so
to
much.
chop up into clips and share on the internet. And Farmer, thanks so much for joining me as a guest co-host here. I think yeah, you did a great job, and I'd love to do this again sometime.